Hey everyone, welcome back to Investment Research. I'm Simo, your equity research analyst, and today we are taking a close look at BigBear.ai, ticker BBAI, focusing on the most recent financial performance, the balance sheet metrics, and what all of this means if you are thinking about buying the stock. To start with the recent results, because the numbers matter. In the second quarter of 2025, BigBear.ai reported revenue of roughly $32.5 million, which was down about 18% year over year. That top line decline was the headline that spooked a lot of investors because revenue had been expected to show more stability given prior contract activity. Gross margin in the quarter was roughly 25%, which is weak for a software-heavy company and reflects lower utilization on a few legacy defense programs and higher relative costs as revenue fell. On an adjusted EBITDA basis, the company reported a negative roughly $8.5 million, which is worse than the prior year adjusted EBITDA and shows that operating leverage has not kicked in. Net loss for the quarter widened materially in part because of several non-cash items, including goodwill and derivative remeasurements, and that produced a sizable GAAP loss that weighed on investor sentiment. Earnings per share on an adjusted basis were negative in the quarter, and the headline per share loss was significant enough to push many short-term traders to reduce exposure. Cash and liquidity are a critical part of the story, and the company has been explicit that its cash position improved relative to earlier periods. Recent public filings and balance sheet snapshots show significant cash and equivalents into the hundreds of millions, which should provide a runway for operations and contract pursuit. At the same time, the company carries some debt, and there have been accounting adjustments tied to convertible instruments that complicate the capital structure picture. Net balance sheet position is not precarious, but it is not pristine either, and investors need to watch cash burn versus contract inflows very closely. Guidance and outlook are the reason the stock moves the way it does. Earlier this year, management updated and then cut full-year revenue guidance as it dealt with timing changes in several U.S. defense programs. The revised revenue outlook lowered expectations from an earlier range to a more conservative range, which highlighted the company's sensitivity to a small number of large government engagements. Because BigBear.ai depends in part on program timing from government agencies, any delays or consolidations on those programs create near-term revenue volatility, even when the long-term pipeline looks attractive. On the commercial side, the company has meaningful optionality. Its decision intelligence software and edge AI capabilities address defense and intelligence markets where barriers to entry are high and contract sizes can be meaningful. The commercial pipeline and partnerships announced over the past months show that there is real market interest in the offerings, which is why institutional investors have been willing to stay engaged despite recent misses. From a product perspective, the capability set maps well to priority areas for national security and large enterprise customers, such as supply chain and logistics optimization, meaning the long-term addressable market is large. Looking at valuation and trading dynamics, you need to be realistic. The stock has been volatile and has seen big swings as guidance was revised and as lenders and investors digested the accounting restatements earlier in the year. Because the business is not consistently profitable, the valuation is effectively a multiple on future execution. If management can stabilize revenue and demonstrate a return to positive adjusted EBITDA, the stock could re-rate quickly. Conversely, if contract uncertainty persists or the company needs to raise capital again, the share price will suffer. For that reason, institutional ownership and short interest trends matter because they amplify moves when sentiment shifts. So, what am I watching as near-term catalysts and risk triggers? Number one is contract timing and updates on the US Army and other government programs. Concrete confirmations of program awards or volume increases would be a clear positive. Number two is the third quarter earnings report and the management commentary around backlog cash collection and revenue cadence. Number 3 is progress on the accounting restatements and any changes to the convertibles or other liabilities that affect diluted share count and leverage. Number 4 is any sign of margin improvement or cost discipline that would show management can drive operating leverage even at current revenue levels. Now, to the question a lot of you asked, should you buy the stock? My recommendation is cautious and conditional. BigBear.ai is a speculative buy for investors who understand and accept the following realities. 1. This is not a stable software commercial compounder today. Revenue can be lumpy and contract timing matters. 2. There is real upside optionality if the company converts defense pilots into multi-year awards and if commercial adoption accelerates. 3. The balance sheet provides near-term runway, but that runway is finite if revenue does not recover or if non-cash accounting items lead to unexpected dilution. If you are a high-risk tolerant investor and you want exposure to defense-focused AI, I would consider a small starter position and use a clearly defined plan to add only on confirmed improvement in revenue trends or on a sustained return to positive adjusted EBITDA. Position sizing should reflect the speculative nature of the name, so think single-digit percentage exposure at most of your equity sleeve and be prepared for wide intraday swings. If you are a more conservative investor, or if you need capital stability for retirement or other goals, this is not a stock to make core. For them, safer alternatives are established enterprise AI vendors or defense systems integrators with steadier cash flows. In plain terms, if you can trade and monitor the name active trading or disciplined, buy the dip additions tied to catalysts could work. If you want to buy and hold without watching headlines, you should probably pass because the outcome hinges on execution and timing rather than on a visible steady revenue stream today. To summarize, BigBear.ai has an attractive technology in a large addressable market, but its near-term financial picture shows revenue declines year-over-year, pressure on margins, and widened GAAP losses resulting largely from timing and accounting items. Cash on the balance sheet reduces the urgent risk of running out of cash, but does not eliminate execution risk. My view is cautiously constructive for speculative investors and neutral to negative for risk-averse or passive investors. If you decide to buy, do so small size with strict risk rules and a plan to add only if you see clear signs of contract wins, margin improvement, and consistent revenue growth. I will be watching the upcoming third quarter release and the earnings call closely, and I will report back with a post-earnings deep read once the numbers are public. I'm Simo from Investment Research. Let me know how you are thinking about this name, and if you want, I can walk through a sample position sizing plan or a timeline of catalysts to watch over the next 90 days.